So Bob had asked me to join him on the panel to basically just talk about the secondary market in terms of kind of price action and what's been going on there. And it seemed to me like the most logical thing to talk about is like, what the heck happened a couple months ago? Because obviously we get that question a lot from our lending clients. They say we were selling loans, everything was great, we were getting 118 premiums, and the bottom dropped out. It was back in August and September. So I think primarily what I wanted to do was kind of address that issue of what led to that, like what caused it to happen. I'll let the folks at those tables I mentioned discuss whether or not it's going to happen again or what we might anticipate seeing as we kind of get in towards the end of the year. But a couple things. I kind of cited 5 major factors that I think, and you guys please jump in, but 5 major factors I think contributed to, it was approximately about a 4 or 5% pullback that we saw back in August and September. So we got the question that came up. I'll address it right off the top. The question came up from a number of lending clients. Was it rates or fear over higher rates? I don't believe in any manner that was the case. It was not a rate phenomenon. But we did have a quarter end, so a lot of people, and it was kind of a soft reason for what happened. Yes, your quarter end came up. It always comes up, and there can be sometimes pressure. But we've also seen prices go up a quarter end. So again, even though that's on my list of factors, I don't really think quarter end pressure necessarily was a major factor. I think it was a minor factor perhaps in contributing. I think the biggest factor on the list, and this has always been the case with SBA, it's a supply and demand game. And there was a ton of paper that's being put, as Bob mentioned, into the secondary market. And as long as there's an outlet on the back end for that, life is good. You buy loans, you pool them up, or you can sell those loans as well. But and then you distribute those, and that machine just kind of keeps going. But when the back end kind of dries up a bit, which is what we saw happen, we saw lower investor demand for pools, specifically in WAC pools. And for those that don't know what WAC pool is, it's a weighted average coupon pool, so it's where you blend coupons together. At the same time, there was really no bid per se for the IO product. So if you didn't make a WAC pool, your other alternative was you stripped the loan and you had an IO. And if you can distribute that IO then again to an end investor, life is good. But when that investor isn't there, it creates some heartache. In this case, what wound up happening is a lot of paper hitting the streets, not a lot of opportunity at that moment to really distribute it on the back end, so dealers' inventories began to grow. As you might imagine, as their inventories grow, but paper isn't moving on the backside of that, naturally their inclination to pay higher and higher prices diminishes greatly, and that's kind of what was going on. So again, you guys stop me if I'm wrong on any of that, because you guys live it, even more than we do. But naturally, that's kind of what's going on there. So, the other thing is that the market, and Bob, maybe you can bounce me to the next slide if you don't mind.
Let me go to the next one, because this one is a little easy to read.
The other thing that was going on, and you probably see this if you read the CPR report that Bob publishes every month. Well, we look at the market from kind of rich, cheap perspective, just basically where our prices, essentially, and then you've obviously got your fair market, or fair value band here in the middle. As you can see, back kind of leading into, early in the year, the market was trading up significantly, especially in the 10-year area. It had been very, very rich. Guys were still buying paper. There was decent liquidity in the market. But as that liquidity began to fall, the market naturally needed to correct as well. So as dealers' inventories got a little heavier, but yet you didn't really have the back-end liquidity that you needed, there's only one way for this to go. And so the market naturally started to correct, as it often does. It overshot a bit here, and would begin to kind of get a bit of a rebound at this point. Obviously, where you can see the longer end is getting back almost to fair value. We still have a little ways to go in the 10-year area. But essentially, that's what happened, at least in my estimation, back in August and September. So people get a little freaked out, a little scared by that, but naturally, when a market is trading at such high levels, that's not indefinitely sustainable. We've all seen this time and time again. The cycle repeats itself, and we'll see this again many, many more times. I think the question, and I'm going to leave this to the dealer community, and the next panel that's coming up is, are we going to see it again soon? I think that's really the question that should be on people's minds. Right now, we've definitely stabilized. Seems like liquidity's returned, which is a really, really good thing. The other thing I wanted to mention, I talked really briefly, just to mention that the talk about rates came up. And while obviously rates did not, as I mentioned, factor into what happened back in August and September, it's definitely something that's on the minds of effectively every lender that we speak to, and I think it's an inevitability. That very soon we're going to see higher rates. The reason I bring that up is because it does beg the question of what about fixed rates? That's a question that always comes up. Is there fixed rate demand in the marketplace? And fixed rates are an interesting thing because typically, when you think of supply and demand, when you start to get a lot more supply of anything, typically prices tend to fall in response to that. Fixed rates are an interesting animal because there isn't a lot of that paper being issued out there. But I do think that obviously if rates go up, you're going to see more and more borrower inquiries saying, "Hey, we'd like to see some fixed rate opportunities here from a borrower's perspective." That being the case, obviously naturally that paper is going to start to get written at some point. There may be resistance early on, but it will begin to get written. As that happens, it will find its way into the secondary market. I actually think that supply on the fixed rate side is a real positive thing from a pricing perspective for fixed rate product. One of the biggest detriments, I think, to prices increasing for fixed product in our space is that there simply isn't enough of it to put pools together. And as I mentioned before, if it's difficult to move that paper forward to an investor, and the pooling mechanism is the best way to do that, obviously there's less of an attraction to the paper itself. So I do think we're going to see more fixed rate issuance coming up. Again, these guys can address that further, or at least weigh in on their opinion. But if rates rise, I do think we'll see more of that. And I think that as that happens, it's actually going to be a positive thing from a pricing perspective for fixed rates. So, again, I don't want to steal the thunder of the guys that are coming up next, so I'm going to kind of stop there. If obviously there's questions, go ahead and you guys can ask Bob and I, but it's probably a good point to start before I get into what they're going to talk about.